Why are you laughing? Okay, today I want to show you how I make money using the wheel strategy. It's basically option selling, puts and calls, but not at the same time. So both of them are going to be covered. They're not naked options. They're covered options. So that means they have backing. So I'm using collateral to sell them. I think it's a much safer way to go, and it's much more passive. When you're selling naked options, then you have to constantly watch your position, because if it starts going against you, you'd have to kind of like fill in the collateral yourself, and that's very active, very micromanaging. So if that's your style, personally, I wouldn't use Robinhood for that. I would probably use one of the other platforms. Maybe E-Trade's better. I have experience with E-Trade, but I don't know about some of the other ones like Ameritrade or anything like that. Also have some experience with interactive brokers. I think that's a decent one to do it on, but it's a little bit complex, especially the app. If you use a lot of desktop, I probably recommend interactive brokers. Although I do have bad experiences with interactive brokers because of the fee structures. But anyway, let's get into the meat of the video here. I'm going to show you what I do. The first thing that I look at when I'm about to sell some options is whether or not I like the company. So it's probably 95% of it. You gotta have a company that you like, and what I mean by I like is not short term. It's not like immediate, next 2 months, next 6 months, next year. It's a bit more long term. Because if I get stuck with that collateral, if I get stuck with that position, I need to know that I'll be able to ride it out for the long term. So that automatically rules out, commodity stocks and things like that. Although I have sold puts and calls on commodity stocks before. I mainly know that I'm going to be able to exit the position within the next 6 months, because commodity stocks is not something that you want to hold long term, usually. Perhaps in this current commodity cycle, I'm wrong about that, but in the past, that's been the case. They're very spiky. So if, you have to have quite a huge insight into commodity cycle to do that. So commodity stocks are out of the question. And also, I don't normally want to do any growth stocks, because growth stocks are very volatile. And although the only thing that really matters when you're selling options is the implied volatility versus what the volatility actually is, it could make growth stock a really good candidate for selling options, but it's just not my wheelhouse, no pun intended. Wheel strategy. So let's go into my latest pick for selling options, which is Goldman Sachs. And in fact, actually, Apple has been a good pick of mine lately. So, but we're gonna do Goldman Sachs. So, one of the first thing I look at obviously is the price chart. So this is the 5-year price chart on Robinhood for Goldman Sachs, and it looks like I'm not playing at the top of the range here, which gives me some kind of comfort. I started doing selling options on Goldman Sachs about this level, $143 level, maybe at 350. Not 143, 343. And after this big drop, and then it's been going downhill ever since, which has been presenting me with a bunch of difficulties. However, I'm sticking to the strategy, and if it goes low enough to where it's not profitable for me to sell options against this collateral anymore, I will probably just ride the position out until it comes to a comfortable place where I feel confident enough to sell options against it again. So this is the 1-month chart. 3-month chart is probably the most indicative of what's been happening. So it's a downward slide. It's a bear market, but collecting a premium in a bear market, as long as it's not too steep, is okay. So I'll go through the process for you. First, I pick the company. Then I go to something like a stock analyzer tool. For example, this one. I like stockanalysis.com. It's free, and I think it's pretty informative. It's got a lot of data on it. A lot of it is not completely up to date, but that doesn't really matter. First thing I look at is statistics, maybe the financial ratios. I want to see what the market cap of the company is. Naturally, I want to see its PE ratio, its PS ratio, which is price to sales. PE just means price to earnings ratio. I want to see price to sales ratio. I want to see things like EV to earnings, which is enterprise value to earnings ratio, and then EV to sales, which is enterprise value to sales. The way you get enterprise value is basically you take the market cap, take the debt of the company, and then you just subtract one from the other, and you basically get the enterprise value. So you'll see here that the enterprise value is quite a bit higher than the market cap of the company, which means that Goldman Sachs carries quite a bit of debt, which is okay for a banking institution. Another thing you should know when you're looking into a company is to know whether it's okay for that industry to carry a lot of debt, or it's not okay for the industry to carry a lot of debt. Like if you have a resource company, for example, and they carry a ton of debt, then that could spell trouble if an unpredictable, turn of events happens where the underlying price of the commodity of that business collapses, then the company's gone. Whereas in the banking sector, it's much more stable, for example, and banking institutions are allowed to carry some debt, especially in a high inflationary environment like we have right now. That's okay. All right, so next up, after I take a look at the figures at a glance, I want to take a look at some of the trends of the company. So I'll go in here and I'll go in the financials and I will start looking at some graphs. So we can see here that the revenue has been growing kind of exponentially lately. That's about to correct in year 2022, hence the price correction as well. We just don't know how far down, and that's why Goldman Sachs has been trending downwards, trying to find its bottom. And I'm of the opinion that it's going to find its bottom pretty quickly, probably 2019, 2020 levels or a little bit above. So I'm not really worried about it coming down another $50, $100 because I know that it will find the bottom somewhere around there, and then eventually it will revert back to its into pretty favorable valuations. I like to look at gross profit trends. I like to look at obviously net income, things like that. Shares change is really big for me. So if we look at the shares outstanding, they've been decreasing. What that means is the company has been buying back its shares and eliminating, part of that total float, which means price appreciation, which means even if the company is not doing, let's say, as well, and they can buy back stock and push up the price of that company in order to meet that, option selling goal of yours. So they're trying to keep the price stable doing that. And that's really working out well for me with the option strats. So keep that in mind. That's a pretty good tip right there. Earnings per share is so next I want to look at things like profit margins. Obviously these are very good, but all kinds of margins: operating margin, gross margin. These numbers here, this is a little bit weird, but you can go to like finviz.com, for example, and check out the figures there. And once I've seen all that, once I've seen the ratios, etc., I might even go to let's see, I might even go to quarterly here just to see how the trend is on the quarterly. You can see that they've actually been raising their cash equivalents, total assets, total liabilities. They're raising with the cash. So basically just expanding the business here. You can see on a quarterly level the revenue has been dropping a little bit, but catching a bit of a bottom here lately in the last quarter. I thought the last quarter report was very good actually. So once I've done a bit of an overview of the business, I just need to know, oh, look at that. There's an uptick in share count. So they've been selling some shares in order to probably to prop up the business a bit. But once I've done an overview, another thing I like to look at real quick is actually their dividend payout ratio. So I want to know that this number here is low. If the payout ratio is pretty high, it means that the dividend paid out is way too big for the amount of earnings they have. And that spells trouble because that means they're going to be reducing their dividend. And that means the stock probably going to drop because dividend investors are going to drop the stock, and some generalists are going to have to pick up the slack. But it means volatility and it means short-term pain, especially as an option seller. That's not a very good idea for you. So that's another tip here. So I like to look at the payout ratio of the company, make sure that's in line. This is extremely low, 13.9%. Anything under 50% is probably good, depending on what sector the business is, though. So keep that in mind too. If it's a stable sector, then you can probably afford a little bit of a higher pay ratio. If you have like real estate, a business, that payout ratio is probably going to be pretty big. Especially REITs, they have to be like 90+%, or at least average 90+%, in order to take advantage of tax breaks. So that ratio is going to be high. So you really got to do homework on what kind of payout ratio is normal for a specific type of business. So there's another tip for you there. Okay, going back into Goldman Sachs here. Once I've established that I like the company, so we're gonna go into what's an inside joke, I guess, for some people. I'll go into the options screen. Now, preferably, I'm looking for fat dividends. Of course, a lot of the stuff, is going to take a lot of collateral. If it's a higher price stock like Goldman Sachs, and it's 350 per share, then you're going to have to keep in mind how much collateral you're putting out in order to collect premium, because it's going to be very expensive. So you really need to keep those ratios in mind. So let's go into the options screen here. First and foremost, of course, as always, you're going to pick a date. Let's say, I like to do a week out, but sometimes I'll do 2 weeks, 3 weeks, a month, sometimes 6 months out. I'll sell an option. It depends on what's a better deal. So I'm looking for deals. So as I'm browsing through here, since let's pretend that I don't have any position and I'm just sitting on cash, I will do, you want to sell an option, a put option, obviously. So this is a week out put option, and then I'm going to look for deals. So it looks like the strike price is about 305. It's a little bit below, it's a bit above 305. So you want to look something below the strike price in order to give yourself some runway in case the stock drops. At least that's what I like to do. So I would probably look to sell an option around the $300 range here. I like to give myself a few percent of possible downside before I have to buy the shares. Even better would be like 297.5 or even 295. But since it's such a large amount of collateral, I want to get my money's worth for the amount of collateral that I put out. So I'd probably sell at this point. If I had to sell puts, I'd probably do the $300 or 297.5, either one. Let's say 300. Then the next thing I would do is I'll look at the bid-ask spread. Okay, so it looks like the margins are not that large. They're fairly thin for this contract, even though there's only 10 and 24 the bid-ask here. And when the market goes live, I'll never do this before or after the market, by the way. That's another thing I'll do. I'll always do it when the market is live, so I can monitor the spread and make sure that I get my order filled at a decent amount. I don't want to be like, set an order and either not be able to fill it or be far below or far above what the market is saying. The premise of the whole idea here is that I don't know what the price of the stock is going to do. Therefore, I want to make sure that I'm as close to what the market is offering as possible. So I'll always do it during a liquid time, like during live hours. And I won't set anything that's got really far or really large margin. All right. So those are some of my principles there. I look at the implied volatility and I try to judge that. This is definitely like, you can't put this into numbers. It's definitely very subjective. You got to try, or what I try to do is I'll try to find a difference between the implied volatility and the actual volatility of the stock and try to determine which one's higher, which one's lower. So if the implied volatility is higher, that basically the implied volatility basically controls the amount of premium that a market maker is going to offer me. And so what I'm going to try to figure out is if that market maker is on or off. So that's kind of where the art comes in. I'm not saying that I'm that good at it, but I'm just telling you, like, that's, very important thing to try to figure out when you're selling options, whether the market makers are right or wrong. And so I'll try to figure it out. So the volatility here is pretty high, and I don't think Goldman Sachs is um, that volatile of a company that the market's given it credit for. And so I think it's a great place to sell options right now. So Bidask Spread, liquid markets, implied volatility versus what you think actual volatility is, and then I'll hit the bid. Okay, I'll try to sell some puts. I'll actually hit the ask, I guess. Um, so I'll sell a couple, and then I'll let it ride out for the entire week. Maybe I can exit the position if the entire premium goes away. Um, so let's say, if Goldman Sachs goes up a ton after I sell these put options, then and they're only worth like $5 each, then I'll probably just buy the options back and then collect my money and then look for a better opportunity in order to sell some more options to invest my money. So that's and basically the process. It's a bit complicated, but once you get used to it, you can do the same thing yourself. But obviously there's a lot of artistry actually. Most of it is figuring out, like I said, 95% of it is whether or not you like the company and willing to hold it long term in case you have to hold it as a collateral. And number two, you have to make sure that it makes sense. It's a good deal out in the market. What I'll do after I collect, Goldman Sachs, is we'll try to sell calls. Okay, so let's say the price drops below your put, and so now you have to sell it. So let's say you have to sell it on, let's say next week you collect 200 shares of Goldman Sachs. You want to sell calls for the following week. So you pick your expiration date, and then let's say the price is 306.664 again next week. Then you try to sell calls. You see how the number gets smaller the higher you go. Um, that's usually, I mean, it's always how it goes, but this premium is actually pretty fat. So when you see a fat premiums like this, that means that the market is skewed. The market makers are expecting this company to go up. So it's actually a good indication. You could front run the market movements based on what the market makers think is going to happen. It's a good predictive tool, but it's obviously not always right. And just like many things, and you can't really rely on it. So I personally don't rely on it, but some people use that as as a tool. So let's say you collected 305. If the premium is really fat like this, I might go quite a bit higher to leave myself some room for profit. So I won't just go 310 and collect $723 per contract, but I'll go higher, maybe 315, and collect only $500 per contract, but leave myself some room in case the stock does actually run up like the makers think. And the object of the whole entire exercise here is not to be too greedy. So if I'm too greedy and I try to collect like 307.5, I'm trying to collect 850 per contract, yeah, I get that money. So I'll get $1,500 at the end of the week, but I might miss out a ton of upside. So what if the stock goes up to 322 and I miss out all that upside? I might leave $10,000 on the table. So I give myself a chance to actually make some money through a trade rather than just premium. But if the stock drops down, then I will use, let's say the stock drops all the way down to like 290, which could happen. I might actually use the asking price, I might use the same price, my entry price, to sell calls at. So let's say I entered at 300 and it dropped all the way down to, let's say, 285. I might sell calls at this 300 level, which is, the price of the option is going to be a lot less than that at that point. It might be just a few $100, which is exactly what I'm doing now. I've actually sold calls for 325 because that was my entry price. It looks like next week I might be able to collect another $400 if the price stays the same. But we might have a green Monday. If we have a green Monday, this premium will be higher. I will sell two of these contracts for at least $200 and then collect $400 by the end of the week. Okay, so that's my actual plan. That's what I'm actually going to do. So this is the nuts and bolts of my option selling method. Some people call it the wheel strategy. I like to call it just like option premium harvesting. Okay, so I don't really have any specific name for anything like that. Wheel sounds fine, I guess, for people. And hopefully that's helpful and gives you some insight into what I like to do and what's my main method of making money in the markets. All right. Till next time, we'll probably make another episode updating the entire account on Monday. Peace out.